Welcome back to our Morning Kappa at 8. I'm Joseph here. Um, so looking at the Hang Seng Index, the index is about to break past this 26,500 point level. At this juncture, we still remain a bullish bias on the Hang Seng Index, premise that the index continue to trade above the 25,000 point level. Now, this level have not changed since a very long time. And you can see that since last year, October, in fact, until recently, January, right, the index is still consolidating sideways. Basically, it's just trading within the band of 26,500 and also the 25,000 point, right? The Hang Seng is waiting more catalysts to stage an upside breakout. And At this juncture, we still keep a bullish bias. Meanwhile, we just take a review on what happened in the past 1 week, right? We can see that the index mainly have a corrections last week, and some of the heavyweights such as Xiaomi, right, and Alibaba, right, are still moving in a very tight range. Only a few counters, such as the Alibaba Healthcare, right, the JD Healthcare, right, have outperformed the peers, as well as the commodity stocks like China Hongqiao, right, and also the Zijin Mining have outperformed their index peers, right? Meanwhile, we can see that some of the bank stocks are very much in a consolidations mode right now. Okay. Um, so on the trading stocks this morning, right? We'll be looking at Alibaba Health Information Technology 241, which the stock have a break past 5 Hong Kong dollar 70 cents. Next hour will be 6 Hong Kong dollar, followed by 6:30. Downside support is at 5 Hong Kong dollar 40 cents. And China Hongqiao have previously, right, tested the 36 Hong Kong dollar. Right now it's moving sideways, pending for a breakout. So if breakout happen, it will move towards 39 and followed by 42. Downside support is at 33. Meanwhile, we look at another counters, which is in the Hong Kong market. I think most paying attention to, which is the BYD. Now, looking at the price volume profile, right, you can clearly see that the resistance at 105 has been very stubborn. So over here, right, I can see that quite a lot of volume, right, has been traded above the 105. Hence, this level has become a very strong resistance for BYD. Now, based on the volume profile, we can see that the bears are in control right now. That's one angle that we look at the counters. Now, secondly, from the other angle is that the stock is trading below the 20 and 50 days moving average. Now, based on the uh, technical indicators, right, the stock also in a bearish fashions. Now, thirdly, right, if we look at the candlestick, right, you can see that a very long bearish candlestick have actually formed right now here. It shows that the stock also under a selling pressure. So right now, where is the level that you should look at the BYD? Firstly, will be their next support level, which is somewhere below the at 92, right? Then on the upside, it will be at 100 and 100.05. Okay, so these are the level that we will be looking at BYD. In case that it break above the 100, right, the momentum will shift on the upside for BYD. Right. Last week, I think there's two pieces of news quite interesting. Firstly, Trump's call for a 10% cap on the credit card on the US banks. That will boost the consumer confidence if this go through. But that will be on the expense on the bank's income. Now, secondly, Trump also have ordered the Freddie Mac to buy another 200 billion of mortgage backed bonds, and that also aim drive the interest rate lower, right? That will also actually give them some sentiment on on the housing market, right? I think both these two of news will boost some of their consumer confidence in the US market. Now, meanwhile, while we are looking at the US market, right? Something that happened at the other side of the part of the world, which is the Iran. We can see that the protests has been ongoing for at least 2 weeks, and that have actually spilled some concern over to the oil market. And on Friday, what we do see is that the WTI crude have actually went up higher, although the Iran crude do not export to the world market as the oil under sanctions. But the largest buyer from Iran will have a difficulty in getting the oil, and the largest buyer on the Iran oil is actually looking for other alternative of oil since their inventory have actually went down lower. Now, all these have actually give some upside momentum on the WTI crude. Right now, we still keep a bearish bias until the crude managed to break past $62 per barrel. Meanwhile, the COMEX gold, right, we still see an upside with the stop loss at 4,000 level. And over the week, the COMEX gold has been edging higher towards somewhere at 4,004 level. So as for the S&P 500 last week, the overall technical setup remains bullish, right? As you can see that the interest rate has been favorable for the market, and the news continue to boost the investor confidence. Right now, the S&P is eyeing to break past the 7,000 level. If the breakout happen, it should climb towards the next level at 7,004, right? So overall, technical setup remains bullish for the SPX. And if we look at over the week, right, the strong demand seen in the Micron MU, right, and as well as the Sandisk SNDK, right, the Intel also jumped by 20% over the week, and another counters among the FANG stocks outperform would be the Amazon, right? Apart from the Fab, the chip company, right? What we're looking at also the Lam Research and also the Applied Material, right? Both have actually delivered a double-digit returns over the week, right? And this morning, I just want to draw your attentions to a few US counters, such as Affirm, right? This is a company that involved in the buy now, pay later, right? Since the interest rate are capped at 10% for the banks, right? Our consumer may also actually look at some of the service that provide by the buy now, pay later. So at this juncture, the Affirm is trading slightly below the 84 US dollar, and based on the price volume profile, right, you can see that the most of the volume actually traded around at 75. So this 75 level will be a very strong support for a firm. As long as stay above this level, and a breakout on 84 should drive the share price higher towards 92 and followed by 100. Okay, right, and secondly, right, since we know that the US right now is going to resume their oil productions in the Venezuela, right, and a lot of the oil equipment should be uh, they'll need to buy all these new oil and gas equipment, and that also actually boosts the sentiment on the Schlumberger, right, stock code SLB. So Schlumberger and another peers called Halliburton, they're actually providing the equipment to the oil field services. And we can see that these two counters has been actually moving up for the past 1 week, right? You can actually look at these two counters as well. Thirdly, I'll pay attention to some of the semiconductor company that provide that sell equipment to the front end manufacturers such as the Lam Research, Applied Material, on semiconductor, right? So last week we had a technical piece on the Applied Material, and right now it have hit our R2, which is at 300 US dollar. So once it break out, it should continue to move on a higher high, right, with the downside support at 265 and 255. Now, meanwhile, today we'll be looking at another two more US counters under our trading stocks. Firstly, the Freeport McMoran, FCX. This counter basically in copper mining. You can see that the share price have actually break past 55. The next level will be 60 and followed by 65. And downside support at 50. And then on last week, Ford have experienced a very strong volume, right? It have actually break past the 14 US dollar. So next level will be a 15 and followed by the 16. And on the downside, our support is at 13. So based on the momentum, right, we'll pick on the Ford and Freeport McMoran. Okay. Meanwhile, we will set the SLB and Affirm or under our watch list. Okay. So let's put our attentions back to our local market. Right. Last week, our FBM KLCI managed to break past that 1685 resistance. It shows that overall setup remains bullish for our benchmark index FBM KLCI. I'm still looking at the FBM KLCI to break past the 1007. So a breakout happen, it should move to 1750 and followed by 1008, right? And on the sectorial performance, last week the outperformer was the technology, followed by the property and constructions. So if you are in the ACE market or even you are in the mid cap or small cap counters, right, you can see that last week most of the tech stock have experienced a very strong momentum. And property sectors have undergoing a counter trend rebound since we are moved into the new year, right? The property sector in totality have returned about 3.78% over the week. And constructions also start to garner buying interest last week after a series of corrections that we've seen in December. Afterwards, Adam is going to have IGM report, right? Stay back on that. And as for the FKRI, right, the index continue to moving sideways, eyeing to break past 1007. So our stop loss remain at 1630 and we keep a bullish bias on the FKRI. Now, meanwhile, the FCPO continue to experience selling pressures and pending on the MPOB data that's going to release this afternoon, right? And we shall see more movement in this afternoon, right? But right now, the immediate resistance will be at the 4001 and followed by 4180. We still keep our resistance or stop loss at 4180, and right now we keep a bearish bias on the FCPO. So the concern for the FCPO right now is the inventory level remains high in Malaysia, right? And the producer are still producing the CPO, right? Supply is high, inventory is high, and the export is actually below expectations right now. Now, one key information that most people actually didn't notice is that if you look at the India, right, the inventory is also at the very high level, almost at a 60% right now. So I think that the Indians exporters are not in aggressive mode to buy our palm oil. And meanwhile, the palm oil also experienced very strong competitions from the soybean oil, which is right now also experiencing corrections. So all these factors move in, right? We just have to see whether the CPO can break the resistance at 4180, right? Otherwise, it stay below the 4180, we continue to stick on the bearish trading bias. Okay, so one piece of news that could boost the upside of FCPO will be the earlier implementation of the B50 on Indonesia, right? And so that have to be seen, monitor closely. So right now we keep a bearish bias on the FCPO. And as for the trading stocks this morning, we'll be looking at IT Max, which break past 490 resistance. R1 will be at 5 ringgit 20 and followed by 5 ringgit 40. Downside support is 4 ringgit and 70. Secondly, we have a hibiscus petroleum break past at 1 ringgit and 55 cents. R1 will be 1 ringgit 65 and followed by 1 ringgit and 70. Downside support is 1 ringgit and 50. So we have two breakout stock, IT Max and followed by hibiscus petroleum. Okay, I'll stop here and pass on to Sian on the Rasa Mingguan weekly economic update. Thank you.
Thanks, Joseph. So, good morning, everyone. Please give me a minute to share my screen. Okay, I hope you can see my screen now. For the weekly Rasa, where for the week ended 9 January, we have penciled in some of our key takeaways from our Pathfinder for 2026. So for 2026, we do see that the global economy, GDP is slated to accelerate to 3.5 to 3.7% in this year, against an estimated growth of 3.2 to 3.3 as per 2025. So investors' continue risk-on appetite and yield-chasing behavior will be the key mainstay themes this year. So Malaysia will likely to remain a relative outperformer within the ASEAN for the macroeconomic perspective. So due to our robust export fundamentals, semiconductor integrations, and also supportive policies as well. For this year, we still maintain Malaysia GDP growth forecast at 4.7%. So on asset allocation wise, we retain an overweight stance on equities, market weight on fixed income, and underweight on cash. The Fed's rate cut reinforced our expectation of a global easing cycle extending into 2026. So market too responded constructively to the decision, with the equities rising, treasury yields declining, and also dollar weakening. Despite our positive view, we're still seeing that there probably will be 5 wildcards that we should be watchful for 2026, as well we pencil in our Pathfinder as well. So firstly, the first wildcard will be the developments surrounding the US midterm elections, where we think that in terms of policy implication, if the midterm results mirror voter discontent, so bipartisan resistance to protectionism could intensify, constraining the administration ability to sustain or expand tariff and likely forcing a recalibration of the trade agenda as well. Secondly, from the market perspective, so we remain watchful for the potential downsides from the AI bubble bust risk as well. So we've refrained from labeling a bubble as a pre-bust. The drawdown may reflect shifting rate cut expectation if it happens, so suggesting the turbulence could be more speculative than structural. So though the outlook remains data dependent as well. So if it emerge, the potential outcome could include broad equity devaluation from indiscriminate selling, a sharp flight to safe havens as well, with a structurally weaker dollar index, so which will actually affect our forecast for this year. So the third wildcard, so which will actually affect the development of the US and China relation, will be the China rare earth export uncertainties, so which will also amplify the uncertainty and spill over across the global trade, investment, and also consumption. So if this happens, so the US will likely face structural constraints, sourcing alternative, which likely to require 12 to 18 months to resolve. So the fourth wildcards that we are looking at is the China's softening domestic fundamentals. So in the base case, China GDP is likely to slow to 4.5%. So in this year, but we also remain watchful of some of the key structural risks in the China economies. So which are coming from the housing market and also the elevated debt in the China itself. Lastly is from the Europe. So for 2026, we pencil in a growth of 1.5% for the Europe. So, but we still remain watchful from some of the key risks in the economy itself, which including weak consumer confidence and also a mix of the elevated inflation in the EU as well for this year. So on the recent incident of the US and Venezuela conflict, so we do see that market move on quickly from the US and Venezuela conflict. The hit and settle invasion, so which lasted several hours, swiftly resolved. So with the gold and oil prices are down, while the equity evaluations are up. So we do not expect negative market developments given the status quo unless the political noise flares out unexpectedly. So for the week ahead, so we do continue to see that there's a further equity rally in the US equities, whereby the risk taking behavior should spill over to the ASEAN market. Just note that our RHB proprietary risk sentiment index is suggesting that there will be a further upside equity bias in the next 2 weeks as well. Closer to home for Malaysia, in last Friday, we have also seen that there's a release of the IPI data for the month of November, where it increased by 4.3% versus October's print of 6%. So meanwhile, the S&P Global Manufacturing PMI, which indicates the manufacturing sentiment, still remain in the expansionary territory at 50.1 points in December, which is also a second consecutive month of expansion in the factory activity. So we maintain a sanguine view of Malaysia manufacturing sector in 2026, with our IPA projection stands at 4.1% for this year. So robust domestic demand is expected to continue to underpin the domestically oriented industries in this year, while the export-oriented industry are poised to benefit from a positive external demand outlook due to acceleration in global activity. As I mentioned earlier on, we will have a higher global growth in this year, a strong E&E demand, and also easing a tariff risk. I think that's all from me for today. I'll pass the line to the next presenter. Thank you.
Yeah, so with two reports from me, one on the energy sector as well, Tenaga. For the energy sector, we remain constructive for 2026. Our topics for the sector are Tenaga, YTL Power, Solar West, as well as Simaden. We do expect news flow to remain quite robust for this year. I think the three things that we're looking out for is, number one is the CREST projects announcements. Number two, the extensions of gas plants, as well as new gas plant awards, as well as your LSS6 and solar tap projects. Number one, CREST projects, we do think that we will see a lot of CREST projects will be announced this year, given that the excess charges that the wheeling or slash wheeling fees that off-takers have to pay to Tenaga will be reduced, has been reduced last year. So with that, essentially what it means is that the project IRR as well as the rates, tariff rates that they will sign will be a bit more attractive, and this should see a number of CREST projects being announced this year. Number two, we also expect more announcement of gas plants extensions. Recall that last year that Tenaga announced that they got extension for 3 gas-fired plants. We do think that you'll probably see Malakoff also get their existing gas plant get extension as well, which should lead to about 8% upside to Malakoff earnings. Aside from that, we also expect EC to announce the awards of the new gas-fired plants. We are looking at about 6 to 8 gigawatts of new gas plants tender to be announced by the first quarter this year. We think Tenaga, YTL Power as well, Malakoff are front runners for this bid, given that they have the experience in terms of managing and operating gas-fired plants in Malaysia. If Tenaga gets about, let's say, a 2,800 megawatts gas plant, we do foresee a 12% project IRR and also 11% upside to their earnings. Aside from that, I think what will help to drive, I think, projects and jobs for your solar names, your LS6 tenders, which we're expecting about 2 gigawatts, and this will include a battery element as well. And with that, we do think that EPCC opportunities is roughly about 10 billion ringgit. For this, we do think Solar West and Simaden are probably the beneficiary of this as well. Moving forward, for Tenaga, we do continue to have Tenaga as a topic in the sector. We do think that their earnings will have a very strong base because of their RP4 related earnings base. But we do see identify 3 catalysts. Number one, they have essentially be able to recognize reimbursement allowance from their tax. Recall that the tax dispute with RRB was already resolved, but the government also basically has allowed for Tenaga to recognize reimbursement allowance for past qualifying capex. So this can come up to about 10 billion, but of course, I think we expect this number to be negotiated between Tenaga and MOF. But any sort of a reduction in 2 percentage point in their effective tax rate do help improve the earnings by 3%. Second one, I think contingency capex. Tenaga has mentioned that they do believe that they can get to 2/3 of their contingency capex approvals. So if this do happen by this year, this adds another 8% upside to Tenaga's earnings. And as also mentioned, any new gas plants tender that Tenaga wins, this adds another 11%. So Tenaga, I think we remain as a topic because they are the best catch-all for the whole rising electricity demand until 2030. And we do peg it at a +1 standard deviation because I think they still give you also 4% yield with an sort of capital upside as well, given that share price has also fallen since the whole court order ruling in July as well. Yeah, I'll stop here and I'll pass on to our next speaker.
All right. Good morning, everyone. So today we have a correction ground check update from our recent visit from Singapore, and we think that Singapore, still has a lot of opportunities for Asian-based contractors, especially from the influx of HDB supply, which is expected to come at about 90.6K units for 2026, which is similar for the past 2 years, which we believe is still good enough to benefit certain contractors such as Suncon via its precast factory, and also Pintara, which is involved in finding works for HDB jobs previously. And additionally, we view that there will be some upcoming developments near the Marina Bay area. We could see potentially some private residential projects along with some commercial or office projects in that area, which should benefit certain contractors, namely Wahab, which is a Singaporean-based contractor, but is actually a partner of IGN for some of its data center projects in Johor. And last but not least, we really did drive along Yishun Avenue 2, which is actually near Chincharu land, which is the land that was bought by Gamuda for its development projects, which has a potential GDP of about 6.9 billion ringgit. And an interesting observation is that near the Chincharu land, just up north of Singapore, there is an upcoming project under construction called the North-South Corridor Highway, which is an elevated highway. So we view, that could likely be some form of key selling point when Gamuda develops this land in Chincharu land with an expected launch date sometime in November of this year. So all in, we view that Singapore continues to be an area filled with opportunities for Malaysian contractors to continue exploring, and therefore, we remain upbeat on the prospect from Singapore, given that the Building and Construction Authority of Singapore expects construction demand to be between 39 and 46 billion Singapore dollars between 2026 and 2029. So that's all from me, everyone. We'd like to wish you a good trading day ahead. We'll see you tomorrow at the same time and same place. Bye-bye and take care.